Okay, so let's take a look at the four parts of every LTC hybrid, the four parts of every hybrid. Now, the first part is usually the single premium. The most popular hybrids are usually funded with one single premium payment. You don't pay annual premiums. There's no ongoing premiums, just one single lump sum premium payment. And how much your single premium is totally up to you. It's very flexible. With most policies, you can pick a single premium, 100, 150, 200, some as high as 250 or 300. Obviously, the more you put into the policy, the richer your benefits will be. Now, and that's why these policies are often called asset-based long-term care, because the funding or the single premium is usually just moving one asset that you have into one of these hybrids. Okay. Now, the second part of every LTC hybrid is the cash surrender value. And the cash surrender value means how much will you get back if you cancel the policy? What will you get back if you decide you don't want the policy anymore? And with most LTC hybrids, or at least with the most popular hybrids, the cash surrender value is usually equal to the single premium. So in other words, you can get your money back if you change your mind, okay? And it doesn't matter when, whether it be a year from now or 10 years from now, whatever. Whenever you want to get your cash back, you can get your cash back. Now, the third part of every hybrid is the death benefit. And the death benefit is usually a little bit more than the single premium. Not a whole lot more. It's usually a little bit more than the single premium. And the death benefit just means what it sounds like. If you need long-term care, if you don't need long-term care, if you just pass away, then your beneficiary will get the death benefit. And again, it's typically a little bit more than the single premium. And that's really the appeal of these policies, is that, hey, if you never need long-term care, at least the policy doesn't go to waste. Okay. Now, if you do need long-term care, however, the death benefit is what's used to pay for your long-term care, usually for the first 25 months. So 1/25 of the death benefit that's usually the percentage. It's usually 4%, or 1/25 of the death benefit is used to pay for your care each month until the death benefit is depleted. Okay, gradually goes down month after month after month, and after 25 months, there's either no death benefit at all, or some policies will still have a small residual death benefit, enough to bury you. So not a whole lot. But when you've done that, when you've depleted the death benefit, well, there's also no longer any cash surrender value. Okay, if you've used up the death benefit to pay for your long-term care, well, then there's no longer any cash surrender value. Now, the better hybrids, after you've depleted the death benefit, will continue to pay for your long-term care through the long-term care rider, or it's called, with some companies, it's called an extension of benefits rider. Other companies call it continuation of benefits, and basically just means that your long-term care benefits will continue. So even after your death benefit has been exhausted paying for your long-term care benefits will continue on that point, after that point, through the extension of benefits. Now, let's just take a look at these side by side so we can just review them. The first part, we've got the single premium. And again, that's totally up to you how much you want to put into it. Second part is the cash surrender value, and that's usually equal to the single premium. And the cash surrender value just means how much will you get if you decide you don't want the policy anymore? How much will you get back? And the third part is the death benefit, and that is how much will the policy pay if you die without needing long-term care? And the death benefit's usually a little bit more than the single premium. And then the fourth part is the long-term care extension of benefits rider, which is typically twice the size of the death benefit. All right. So you pay one single premium. If you want your money back, you can get your money back. And if you die without needing care, well, you get the death benefit. And of course, if you do need long-term care, you get long-term care. There's only one problem with this chart. One problem, and that is the conjunctions. With LTC hybrids, you don't get cash surrender value and a death benefit and long-term care benefits. You're only going to get one of these. You're only going to get the cash surrender value or the death benefit or the long-term care benefit. For example, if you surrender the policy, if you take out the cash surrender value, well, then you forfeit the death benefit and you forfeit the long-term care benefits. If you die suddenly without needing care, well, yes, your beneficiary will get the death benefit, but there's no long-term care benefits, and your beneficiary does not get the cash surrender value. Your beneficiary just gets the death benefit. Or if you do need long-term care, if you need long-term care for at least 25 months, then that wipes out the death benefit and that wipes out the cash surrender value. So you're not going to get all three benefits from the policy. You're just going to get one. Okay, you're going to get the cash surrender value or the death benefit or the long-term care benefits. Okay, so let's take a look at a case study. All right, let's look at a side-by-side comparison of a long-term care hybrid versus a traditional long-term care insurance policy. And we're going to look at two couples. We've got Lucy and Ricky, both age 59, and we've got Jim and Pam, both age 59. And Lucy and Ricky buy a long-term care hybrid with a 3% compound inflation protection. All right. And their policies start off with a $4,800 monthly benefit per spouse. And because of the 3% compounding, that's going to grow every year. By age 83, they're going to have $9,600 per month per spouse in benefits. Now, the lifetime benefits, the long-term care benefits, start off at $350,000 per spouse. And that also grows every year by 3% compounding. So by age 83, they've got $700,000 worth of long-term care benefits per spouse. All right. And how much is that going to cost Lucy and Ricky? Well, it's going to cost them $200,000. Okay. $105,000 for Lucy's hybrid and $95,000 for Ricky's hybrid. Now, when you do the math and you look at the leverage, that's really not so bad. That's not such a bad value because by age 83, well, they've got $700,000 each. So they've got, that's $1.4 million between the two of them. Well, they've got 7 times what they put into the policy. So that's providing significant leverage and protection against long-term care expenses. Now let's take a look at Jim and Pam. All right. Jim and Pam buy a traditional policy, also with a 3% compound inflation protection. All right. And they also start off with a monthly benefit of $4,800 per spouse. And because of the inflation protection, that's going to grow to $9,600 per month per spouse by age 83. So you can see we're comparing apples to apples here, the same starting monthly benefit for each couple, and the same, inflation protection, growing the monthly benefit for each couple. Now, Jim and Pam, though, since they're buying a traditional policy, they're going to buy shared benefits. Most traditional long-term care policies allow couples to share benefits, and that can be a really good value in many cases. So they're going to start off with $875,000 worth of shared benefits. And that's going to grow every year, also by the 3% compounding. So within 24 years, by age 83, their policy is going to have a lifetime long-term care benefits of $1.75 million that will be shared between the two of them. Now, You might be saying, Scott, I've never heard of a long-term care policy that has such rich benefits. That, and if you do the math, you can see that this is 15 years of shared benefits that they'd have. They'd have a total of 15 years benefits of benefits that they'd be sharing. And Scott, I've never heard of such a thing. Don't traditional policies just have 2 years of benefits or 3 years of benefits? Well, no. And that's why you're watching this webinar, okay? Because you're learning things here that you don't hear anywhere else. So, so now this policy for Jim and Pam, their combined annual premium is $4,300. That's not per person, okay? That's not per spouse. That's their combined annual premium. That $4,300 covers both of them for these benefits. And there are no planned premium increases with this policy. So even though the 3% compounding grows the policy benefits every year, the growth in the benefits does not make this premium go up. Now, let's take a look at these, let's compare these two strategies side by side, depending upon different scenarios. So clearly these two couples have very different strategies that they've chosen. And what I want to look at now is look at the three possible scenarios. There are three possible scenarios, and then look at which couple is better off in each scenario. Okay. So first off, we know that Lucy and Ricky bought two hybrids. Lucy's hybrid cost $105,000. Ricky's hybrid cost $95,000. So combined, they've put in $200,000 into their hybrids. Now, Jim and Pam, though, did something a little different. Jim and Pam put $200,000 into a special investment account that they set up on their own. And they're going to earn money on that $200,000 every year. And they're going to take the earnings from that special investment account, and they're going to pay their long-term care annual premium. Their annual premium is $4,300. And so all they need to do is earn about a little more than 2% on that $200,000 every year. And that'll be enough to generate enough return to pay their long-term care premium every year. Now, 2%, 2.5%, that's not a lot of money that they need to earn to pay their annual premium. Now, what are Lucy and Ricky earning on their single premiums that they paid? What are Lucy and Ricky earning on their $200,000? 0%. Lucy and Ricky are earning nothing on that $200,000. They're earning 0%. Now, you might say, well, Scott, that's not true. The illustration that I have shows that the policy has this hybrid has a guaranteed interest rate of 4%. Well, it probably does say that. But that 4% is being credited to internal values. That's not your real interest rate that you're earning. If you surrender the policy, they're not going to give you $200,000 plus the interest. If you surrender the policy, they're going to give you back what you put in. If you put in $200,000 and you surrender the policy, they're going to give you back $200,000. In other words, Lucy and Ricky are earning 0%. If they surrender it, they're going to get back what they put in. They're earning nothing on that $200,000. Now, yes, Jim and Pam, they're going to earn money on that investment account each year, hopefully enough to pay their annual premium each year. And yes, their annual premium, if they never need long-term care, those annual premiums are wasted money. Wasted money if they never need long-term care. But Lucy and Ricky are wasting money too, because Lucy and Ricky are wasting what they could be earning on that $200,000. All right, so let's look at the different scenarios. Scenario number one is if they need long-term care. What if Lucy and Ricky need long-term care? What if Jim and Pam need long-term care? Which strategy is going to be better? Which couple is going to be better off if they need long-term care? Well, if Lucy and Ricky need long-term care, of course, they're going to get long-term care benefits from their hybrids. Now, if they need at least 2 years of care, all right, well, then they're going to lose the death benefit. They won't get any death benefit. And of course, if the death benefit's been used up, well, there's the cash value is gone. Okay. And of course, they're not going to get their single premium back either. So, sure, if Lucy and Ricky need long-term care, they're still better off than if they didn't have a policy because they're going to get back at least what they put into it. And with Lucy and Ricky's policies, they each have 6 years of benefits. So potentially they could get back significantly more than what they put into the hybrids. What about Jim and Pam? Well, Jim and Pam have much richer long-term care benefits than Lucy and Ricky. In fact, Jim and Pam have 15 years of shared long-term care benefits. And one of them can use as many as 10 of those 15 years. So it's significantly richer long-term care benefits than Lucy and Ricky have. And if they need care, well, their premium stops. When Jim and Pam need long-term care, their annual premium for their policy stops. They don't have to pay it anymore. So the money that they're earning on their investment account is just going to be reinvested. And that investment account is going to grow and grow and grow every year. The longer they need care, the bigger that investment account is going to get. And so Jim and Pam in this scenario are much better off than Lucy and Ricky. Jim and Pam have richer long-term care benefits, and their heirs will get whatever that investment account has grown to. Lucy and Ricky, sure, they're going to get the long-term care benefits, but the original $200,000 that they put in, that's gone. That's gone. But Jim and Pam, the $200,000 they put in their special investment account, that's not gone. That'll go to their heirs. Let's look at scenario number 2, using the cash. What if Lucy and Ricky want to use their cash? Let's suppose that they want to go on a world cruise. Well, if Lucy and Ricky decide to take out the cash value, which is $200,000, they don't get the single premium also. They just get the $200,000 cash value. They don't get a death benefit anymore because they're surrendering the policy. They don't get long-term care benefits anymore because in surrendering the policy, they forfeit the long-term care benefits also. And what about Jim and Pam if they want to cash? So let's suppose Jim and Pam want to go on a world cruise. Well, they can just take their money from their investment account, take out that $200,000. Okay. Their long-term care policy is still going to remain in force. They still got all their long-term care benefits. As long as they pay their annual premium on time each year from their other income sources, Jim and Pam still have their long-term care coverage. Lucy and Ricky, they've had to forfeit their long-term care coverage to get to the cash. Jim and Pam, they can get to their cash. It's fully liquid, and they can still keep their long-term care policy in force. They don't lose their coverage. Now, what about the third scenario? What if they just die? Okay, what if they don't need long-term care and they just die? All right, which couple's going to be better off? Well, if Lucy and Ricky just die without needing long-term care, well, their heirs are not going to get the single premium. Their heirs are not going to get the cash value. There's no need for long-term care. Nobody's going to get long-term care benefits. They're just going to get the death benefit, which is fine. That's more than what they put into it. At least their heirs are going to get the death benefit. But what about Jim and Pam? They had a traditional long-term care policy. There's no death benefit with the traditional policies. Well, let's see. Jim and Pam, if they just die, sure, they don't use their long-term care policy. They never get any benefit from their long-term care policy. But guess what? Jim and Pam still have their investment account, and that investment account is going to go to their heirs. So that 200 grand that's been sitting in their investment account, earning enough every year to pay their premium, well, that 200 grand is going to go to their heirs when they die. So sure, Lucy and Ricky's heirs are a little better off than Jim and Pam's heirs in this scenario. Okay, Lucy and Ricky's heirs get 230 grand. Jim and Pam's heirs only get 200 grand. So in this case, Lucy and Ricky are slightly better off. Their strategy is slightly better than Jim and Pam's. But on the first two, clearly Jim and Pam's strategy was the better strategy.